Hello, we're still on the portfolio theory, and here we're going to treat covariance. So, what does covariance tends to do or to measure in portfolio theory? The covariance measure the extent to which the return on investment could vary or could move. Covariance is trying to look at the movement on the return from a portfolio. That is, because in a portfolio we have more than one securities in the portfolio. So it tends to do what covariance tends to do what to measure how the return move. How the return from this investment in the portfolio move. How does it behave? How does it move? So the covariance measure the extent to which the return on investment could vary or could move. If the returns move up and down at the same time, we have positive covariance. However, if the investment move in opposite direction, we have negative covariance. And if there is no co-movement, no correlation, we have covariance of 0. So we are looking at the relationship between the return from the investment. If the return from between investment move up at the same time or move downward at the same time, we are said to have what? A positive covariance. But if the return from the investment moves in opposite direction, that is, the return from one investment is moving up and the other is moving down, so we say we have what? Negative covariance. But if there's no relationship among them, if there's no co-movement, that is, no correlation at all, that is, each investment is independent of each other. At least the movement of one does not determine the movement of the other. We say we are said to have a 0 covariance. So don't get it twisted. I'm talking about negative covariance whereby the investment are moving in the opposite direction. It means one investment is affecting the other. That's why one is moving towards the opposite direction, and the other one is moving towards the other direction as well. So if the movement of this return from the investment are independent of each other, we said to have what? No correlation. We no covariance. So in which we said there's no correlation between the return. So by that we say we have 0 covariance. So how do we now calculate this covariance that I'm talking about? So the formula for calculating our covariance is what? PP, summation of what? P is what? Is the probability. So it means first and foremost you have to compute your what? A minus A bar. Where A is what? Return on each state of project A. So A bar is what? Expected return. So return minus the expected return. So for project A. So also do likewise for what? For project B. So it tends to do what? To multiply the two. After that, it now tends to do what? Now multiply by the probability of each state. So the summation, now after you have multiplied by summation of each state, so you now sum it up. You sum this, what you have. This, you compute this separately. So after that, you multiply this, you now multiply by what? By the probability. So you now sum it up on each state. So by that, we have your covariance. So as I've said, I'm still coming up with a comprehensive question where we want to do what? To exemplify, to practicalize what I've been talking about. So let me quickly train the concept of what? Of correlation coefficients. Correlation coefficients. Let's quickly look at correlation coefficients here. correlation coefficient. Correlation coefficient. So this also measures. So the correlation coefficient, this also what measures risk, and the higher the risk, the higher the correlation coefficient, and the higher the correlation coefficient. Also coefficient, while also the lower the risk, the lower the correlation coefficient. So how do we calculate? So correlation coefficient is calculated thus. So the formula for calculating our correlation coefficient is what? Covariance of A and B. Covariance of A and B lying on standard deviation of A, and our standard deviation of A, of project A, multiplied by standard deviation of B. So that is exactly what correlation coefficient is. So we use this to do what? Well, to measure the intensity of what? Of the risk. So this also measures risk, and the higher the risk, the higher the correlation coefficient. So the correlation coefficient tends to do what? To measure the intensity of what? Of the risk. That is, how high or how low is the risk that we are talking about. So that we're able to do what? To compare with the return. So when you have the risk, the rate of the risk and the return, you can compare and make your judgment and make your decision on whether to do what? To invest on such investment or not. So having done that, it will be able to do what? To serve as a guideline for you to do what? To make decision at the end of the day. So, and the formula for calculating is what? Is covariance of A and B, in which we just treated all over the standard deviation of A multiplied by what? By the standard deviation of B. So in a video to come, we're going to do what? See how we're going to solve a particular question to do what? To exemplify, to practicalize this theoretical aspect. So at this junction, I'm going to call it the class now. So, as I normally urge you, if you have not subscribed to the channel, kindly click on the subscribe button and subscribe. Share the video, like the video, invite your loved ones to the channel, and I'll be very grateful you do that. Thank you very much and stay blessed. I remain yours sincerely, Abdulrahman.